Hello, I'm Kathleen and my student number is 908650. I'll be discussing my work for the FIN332 final assessment. My report focuses on three main parts: fund management strategies, event-driven trading strategies, and hedging using options through the barrage strategy. The aim was to analyze real market data, construct trading portfolios, and evaluate the performance using measures like returns, standard deviation, and Sharpe ratio. I also applied market microstructure concepts to understand liquidity, order execution, and how investors respond to market events. This report combines theory and practical application to show how different strategies can be used for effective portfolio management and risk assessment in financial markets. The first part of my report looks at fund management strategies. I compared active mutual funds with passive ETFs over 5 years. I selected passive mutual funds and ETFs that track similar benchmarks covering large cap, mid cap, and multi cap. The results showed that ETFs performed better in large cap indices due to lower costs and higher liquidity, while mutual funds outperformed in mid cap and flexi cap categories, where active management added value. This highlights that the choice between active and passive funds depends on the market segment. I also analyzed liquidity differences. Mutual funds are bought or sold at the end of day NAV, while ETFs they trade on the market throughout the day and are generally more liquid, so it allows faster access to funds. This analysis shows how fund management style, cost, and liquidity impact risk-adjusted returns. Understanding these differences help investors make informed decisions about whether an active mutual fund or a low-cost ETF is suitable for their investment goals. The second part of my report focuses on event-driven strategies. I selected a recent geopolitical event, Operation Epic Fury, which is the joint US-Israeli military campaign against Iran, affecting the Strait of Hormuz, which is a major oil shipment route. I calculated abnormal returns and cumulative abnormal returns for crude oil and gold based on historical price changes. Crude oil prices spiked immediately after the event, showing strong AR and CAR, while gold acted differently compared to the Gulf War of 1991, reflecting changing market dynamics. During the conflict, investors displayed risk-shifting behavior, moving away from equities and mutual funds towards safe haven assets like crude oil and the US dollar. This shows the importance of liquidity and risk management during high uncertainty events. I developed three trading strategies around the event: long position in crude oil and energy ETFs to benefit from price spikes, short positions in gold and gold ETFs due to the expected price decline, and short positions in UAE stocks affected by the conflict. After executing these trades, the market reached as expected. Crude oil prices increased, while gold and UAE stocks prices declined, resulting in an unrealized capital gain of USD 1,352.67. This demonstrates how event-driven strategies can capture short-term market opportunities. The third part of my report focuses on hedging using options through the barrage strategy, also called a covered call strategy. This involves buying an underlying asset like a stock or index and writing an out-of-the-money call option on the same asset. The goal is to generate income from option premiums while reducing portfolio risk. I constructed a portfolio with 6 major Nasdaq equities: Apple, TSM, Nvidia, Microsoft, Coca-Cola, and Netflix. For each, I took long positions in the stocks and simultaneously wrote call options to earn premiums. I also applied the strategy to 5 Indian stocks and 2 indices for comparative analysis. The results showed that the buy-ride strategy provided high risk-adjusted returns compared to holding just equities. For example, Sharpe ratios and average returns were improved due to premium income buffering downside risk. The strategies perform best in neutral to moderately optimistic markets, but may underperform during strong optimistic markets because the upside is capped. Overall, the buy-ride strategy is an effective risk management and income generation tool. It doesn't violate market efficiency and provides consistent returns with lower volatility, making it suitable for investors seeking steady risk-adjusted performance rather than just maximum upside. Thank you.